Sure. I think the most glaring thing that you will see when you look into our portfolio is actually what we don't have today, and it's actually been a fairly consistent weighting for us. We have no IT exposure, so we're not underweight. We have no exposure to IT, and it's fairly common for us to have no exposure to an individual sector. If you look back at our history, at one point in time, we have not had exposure to 9 of the 11 sectors. So again, that building the portfolio bottom up, one stock at a time, really comes through in our sector exposures if you look at them over a broad period of time. Today, we have no exposure to IT, and it's not that those stocks within IT do not fit our process. They do. They do from a business model standpoint. They do from a share orientation standpoint, and financial strength. The area where today they don't fit is valuation. So the valuations on those individual securities are in excess of what we're willing to pay, and we think they're above the intrinsic value of those underlying businesses. So today we have no exposure to IT. Where do we have exposure? Is sort of the next part of the answer. And you think about our portfolio today. I think one, we're well positioned for a rate cut, and we've just got one last week, and it sounds like we're going to get more easing as we move forward. Our exposure to some home builders, we've got some industrial names that should benefit from lower rates, some alternative asset managers. So we think our portfolio is well positioned for lower rates. And then lastly, we are overweight financials. And what's interesting about our overweight in financials is the fact that we don't own banks. We have not owned a bank for quite some time. We get our exposure in that financial bucket, and it's been the best performing sector for our strategy since inception. We get that exposure through insurance companies, insurance service companies, and alternative asset managers.